The analysis profit of conflicting symbols measures the average performance of trades when you have a conflicting position compared to trades when you do not. A conflicting position is defined as a position when you have the asset at the same time open as a long position and a short position. In case the lot size is the same, the position eventually even each other out. While not benefiting in case the asset increases or decreases, the trader still faces trading cost. Trading costs, although they seem low for many brokers, still are one of the major factors when becoming a profitable trader. Each position might only cost a fraction of the potential profit or loss. However, also the small payments for trading costs add up. Imagine your trading will be plus minus zero, losing exactly as much as you win. You will still end up with a loss at the end of the day because of the trading fee. Trading costs should not be underestimated, as the profit you make first of all have to cover those before you can realize any profit. Your winning probability of a trade of 50% is actually slightly less, 49.5%, 49%, 48%, depending on your trading cost. The higher your trading cost, the better you have to be in order to realize a net profit. This is especially true in scalping and day trading when you have many trades with only small wins or losses. The influence of trading costs on your overall performance is even larger. We have a dedicated analysis on the trading costs you are facing with your current broker and whether you have the potential to save on trading costs in case you would use a different provider. Please refer to the video of that analysis under cost for further details. If you open a long and a short position for the same asset at the same time, you face additional trading costs. Of course, using a hedge position or creating exposure to different currency through partly hedged position can well be a trading strategy that makes sense and justify the additional trading cost. Nevertheless, oftentimes we see new traders that open conflicting positions without actually having a strategy behind it. For example, we see situations where a trader has a long position in EURUSD, a long position in USD-JPY, a short position in EURGBP because they may have seen some technical setup and quickly open a position in each of the pairs, without actually considering which position they have open at the same time already. The euro exposure of the long EURUSD trade and the short EURGBP trade conflicts. Moreover, the US dollar exposure of the long EURUSD and the long USD-JPY also conflicts. Lastly, even the Japanese yen exposure conflicts with a long position in USD-JPY and a short position in EURGBP. Eventually, the trader pays 3 times trading fee, however, is not really able to benefit from the position overall, as they will equal each other out. Now, let's have a look at how this might actually affect your trading performance. Looking at the chart, we see the average performance per trade in case the trade was open with a conflict to other positions versus when the trade did not have a conflict. Besides the profit per trade as shown in pips here, it is also important to check how many trades fall into each category. For this trader, we see that the average performance per trade is actually slightly lower for trades that had a conflict, which makes sense due to the trading cost. Moving with the cursor of the bar, we can see that there are only very few trades with a conflict. In this case, the trader performed only 54 trades that had a conflict, while in 1,446 trades, there was no conflict. Looking at a 3-month time frame, we actually see that the trader only had 1 trade with conflicting symbols. You may encounter that you have a similar output compared to this trader, realizing a smaller profit in case your position was in conflict to another position of yours. In case a hedge position is not part of your strategy at that point, it could well be profitable for you to seek other trading opportunities than opening a conflicting trade. In case you encounter that you are about to open the position, which would be a conflict to another position of yours, you should question whether the other position is really still be worth keeping open. For example, you have an open position in EURUSD long and you are about to open a new position in GBPUSD short. Talking to traders about the reason why they opened the new position, which is in conflict to another open position. Here, the new GBPUSD short trade, they usually have good arguments to do so based on a technical setup, their strategy, or other reasons. When asking them why they keep the old position still open, here in our example, the OEURUSD long position, the arguments oftentimes are much less solid. Many times, the old position is actually in loss already, however, the stop loss is not yet hit. When asking them whether they would open that old position again at the same price level as the price is at that point, most of the traders deny that. Yet, they do not close the position, wanting to open another position which is actually in conflict to your old position is one of the major signs that you actually do not believe in the other position anymore and might be better off just closing it. Just keeping a position open and hoping that the trade still goes into profit, but your original setup does not apply anymore is something oftentimes seen but not profitable. Again, there are certain situations in which a simple conflict can be justified in trading, but more often we see a sign of legacy position with outdated trading setups and the creation of additional trading costs for your account. Therefore, the value of this analysis might not only be in the actual average profit of the trade with conflict or not, but actually also in the shares of trades falling in each of the categories. If you have a considerable amount of trades in the conflicting symbols category, it might well be that you struggle closing positions that do not fit your strategy anymore. In case you do have a significant loss-making pattern due to opening conflicting symbols, you may choose to receive a notification from us warning that you have just entered another conflicting position which on average end up with a loss in your trades. Trading can be very demanding, and a little technical support may actually help to free your mind and focus better.